Listen, if you've ever felt completely overwhelmed by endless charts, flashing lights, and literally a million overlapping indicators, just take a breath. We're going to unpack a mechanical day trading playbook that promises to totally flip the script on your frustration. It's a highly structured strategy, and it's designed to be absolutely, well, stupid simple. Okay, let's dive right into this, because the creator behind this strategy makes a wildly bold claim right out of the gate. They actually state that this specific method helped them become a seven-figure trader. No spending years trying to master a mess of complex technical jargon, none of that. And honestly, when you look at the feedback from their own community, it's consistently described by everyday folks as nothing but simple, stupid, and effective. So we really have to ask ourselves, what if day trading actually was stupid simple? This concept completely challenges a massive assumption so many of us have, that to be a successful trader, you inherently need to spend years analyzing incredibly noisy charts just to find a tiny edge. Think of this explainer as your antidote to all that overwhelming market noise. Stripping away the clutter might just be exactly how you uncover the absolute best setups. Here is our playbook for today. First, we'll reveal the box theory itself. Second, how to literally draw the box. Third, the anatomy of the box. Fourth, 3 strict rules of trading. And finally, why it all comes down to probabilities over perfection. All right, part 1, the box theory revealed. For anyone who's just exhausted by trying to read the tea leaves of indicator-heavy charts, the source offers a pretty brilliant alternative. The box theory is a completely mechanical, rule-based strategy. It strictly uses the previous day's high and low price points to identify extreme, high-probability reversal zones. The creator claims this method is so remarkably robust that if they had to start from scratch and wanted to make $1,000 every single day, this is exactly what they'd use to find the strongest buyers and sellers in the entire market. Moving on to part 2, how to draw the box. Now, the source heavily emphasizes that drawing this correctly is crucial. If your box is wrong, your data is wrong, and literally nobody wants to risk their capital acting on bad data. So here's the action plan. Step 1, pull up a daily chart of whatever you're trading. Say it's Apple stock. Find the previous day's absolute highest point and absolute lowest point, and make sure you include those little wicks at the ends of the candles. Step 2, simply connect those highest and lowest points to draw a box. Step 3, just eyeball it and draw a horizontal line right in the dead center of that box. It doesn't have to be visually perfect, you just need to establish those 3 distinct zones. Once you've got that foundational box drawn on the daily chart, the sheer beauty of this strategy is its total flexibility. You can then drop down to a 5-minute chart, a 1-minute chart, a 1-hour chart, whatever your preferred smaller time frame is to actually execute the trade. The creator points out that the analysis of those lines remains exactly the same no matter how far in you zoom. Okay, part 3, anatomy of the box. So now that we have our lines, what do they actually represent in human market maker terms? Well, the top of the box represents the strongest, most well-funded seller. It's the exact reason the asset previously rejected that price and aggressively sold off. The bottom of the box is the exact opposite. It represents the strongest, most well-funded buyer, where massive liquidity is just sitting. And that center line, it represents absolutely nothing. It is purely noise, confusion, and total indecision. It's where amateur traders go to get chopped up. Which brings us right into part 4, the 3 rules of trading. With this psychological battlefield mapped out, the source issues a huge warning against just wandering into the market's lion's den. To survive, you have to follow 3 strictly non-negotiable, delightfully straightforward rules. 1, do not buy at the top of the box. 2, do not sell at the bottom of the box. And 3, do not diddle in the middle. The creator warns that if you challenge the strongest sellers at the top or those well-funded buyers at the bottom, you are going to, in their very colorful words, get cheesed every single time. And finally, part 5, probabilities over perfection. To make this strategy viable over the long haul, we've got to look at the underlying math. And the number 80% is the absolute anchor of this entire theory. The source claims that there's up to an 80% probability that the strong buyer or strong seller will return right at those absolute edges of the box. These aren't just random guesses. They're known data points where major market players have already shown their hand and their funding. When you stack these zones up side by side, the math becomes super clear. Trading the edges offers a potential historical win rate of 70 to 80% with incredibly well-defined risk. Trading the center, though, that's a 50-50 coin toss filled with terrible whipsaw action and awful risk to reward. The source uses a hilarious analogy here. Sure, you might occasionally see a stock blow straight through the top of the box, just like you might occasionally see a monkey ride a bicycle. I mean, it happens, but it's really not a common occurrence, and you definitely don't want to bet your hard-earned money on it. Let's make this real with a classic trap using Apple stock as an example. Imagine you're staring at your screen, and there's this massive, incredibly powerful green candle violently hitting the very top of your box. To almost any retail trader looking at that momentum, that looks like a guaranteed bullish breakout. It looks like you'd be a total fool not to hit buy right then and there. So I've got to pose this direct question to you just to test what we've covered. If your hands were tied behind your back and you were forced to push a button right at that top line as that huge green candle approaches, do you hit buy or sell? Well, according to the rigid rules of the box theory, even though it looks incredibly bullish, you hit sell. Why? Because you know the largest, most well-funded seller is waiting right there in the lion's den, completely ready to trap eager buyers. But hey, we all know markets do weird things, right? What happens when the market opens completely outside yesterday's box? The source addresses this exact exception with what they call the cheater box. Using an S&P futures example, they explain that if an asset gaps heavily up or down right at the open, you just adapt. You create a new alternative box by connecting the absolute highest and lowest price points of the current session you're looking at. And the coolest part is that regardless of when or where this cheater box is drawn, those exact same 3 rules absolutely still apply. Ultimately, this mechanical approach elegantly solves the most critical part of trading, risk versus reward. Because you're getting in early at the very edges, your stop losses can be placed incredibly tight, just right underneath or above the box. So for the 20% of trades that inevitably fail, your capital losses are tiny. Meanwhile, your profit targets aim all the way back to the center line or even the complete opposite edge of the box, giving your winning trades maximum upside. This all builds up to a pretty crucial philosophy captured perfectly by the creator. The key to being a successful professional trader is trading probabilities, not perfection. It's 100% about consistently siding with the biggest players in the market, protecting your capital with those tight risk parameters, and just aggressively blocking out all the irrelevant garbage and noise in the middle of the chart. Which leaves us with one final provocative thing to think about as we wrap up. Are you ready to stop diddling in the middle and start trading the edges? We've explored the mechanical setup, the deep psychology, and the compelling math behind the box theory. It's a really fascinating look at how stripping away all the complexity might just be your ultimate edge in the markets. Thanks so much for hanging out with me for this explainer, and I hope this clear, structured look at the source material leaves you totally eager to spot these setups out there in the live markets.